Welcome back. You're watching Trading Hour on CNBC-TV18. Now, let's move on and talk about Medi Assist Healthcare Services. They reported their Q3 numbers, which was seeing a very strong growth in terms of revenues. We're seeing the premium under management also seeing a good growth of around 17% for the 9-month time period. Profit after tax, that came in a bit under pressure on a year-on-year basis. Now, we're joined by the management of the company, Satish Gidugu, who is the CEO at Medi Assist, to talk to us about their quarterly numbers and the outlook of the company going forward. Satish, good morning and thank you so much for joining in with us. Now, firstly, let's start by talking about this premium under management which is there. That's managed to see a good growth of around 17% for the 9-month time period. Could you guide us? What is the outlook for Q4, FY25 and FY26? What is the growth that we're expecting here? And, could we expect the 17 to 20% range of growth, something that could normalize from here on?
Morning, Billy. Thank you for having me on this call. And there were too many questions, so I'll attempt to answer each one of them one at a time. So we've seen a good growth both on group and retail premiums. We've grown faster than market in both of the segments, mostly backed on our own organic growth, plus including the acquisitions that we've just concluded. So I think we've always said in the past that we will match or better the industry growth rates in both group and retail, and that continues to be our outlook for the current year and the future year.
Any growth, Satish?
We will match or better the industry growth rates.
No, you said the growth this time was a combination of the acquisitions and organic growth. So what was the organic growth in the current quarter?
Hi, Reema. Always a pleasure to meet you. Been here since listing, so thank you for having me here again. The way this industry works, Reema, is that the day we conclude the acquisition, it becomes organic because we are responsible for 100% retention. So it's very difficult to tease out the numbers, which is organic and growth. But and remember, the base only has the proportionate value of the premiums, that we've added.
Right. Satish, what I want to understand and what I was reading, some analysts have highlighted that, these EOM guidelines which have come in, because of that, there's some bit of a pressure from the pricing side for insurers, and anything that is possibly that could impact the group segment growth going forward. Is that something that you should be worried about?
So I'm going to split that into two parts, Vinny. One is, of course, there is pressure in group, while the employment numbers haven't really stacked up, as much as we would expect across the group segment in multiple industries. So it did put some pressure in terms of employment growth, which is a key driver for the group premium growth. And hence it is a little suppressed. So there's also more increased competition in the group business. But on the positive side for us, especially with the regulator's new master circular mandating certain kind of quality and service delivery parameters, and we've focused heavily on two things in the last 1 year. One is the policyholder experience. How do I improve, for example, on an average, we're getting 10,000 patients out of the hospitals every month, even before the bills are generated. They don't have to wait even for a second, even for a bill to be generated. And we've also focused heavily on improving insurers' outcomes through a better fraud, waste, and abuse prevention. In fact, the fraud-related savings we delivered to insurers grew about 2.5 times compared to the previous year, same period. So with these, we continue to maintain our right to win, even in group. Collectively, our retention on an annual renewal business has moved up to 95% from what used to be about a 94.3%.
So then does that mean that, if the competition is increasing in the group segment, this 15% growth which you've gotten during this quarter is something that could be a bit lower maybe here?
I don't necessarily see them as related. We are on the service provisioning side. And in fact, I think with the amount of churn that we're seeing in the group, with the groups changing from one insurer to the other, I think our ability to provide continuity and exceptional control on costs and medical inflation is something I believe will only improve our right to win.
Retail has been doing well for you. So can retail be the growth driver, and even the government share? How do you expect that to play out, Satish?
Yes, Reema. So I think on retail, from last year till now, we've added 3 more new private insurers to our retail book. And in most of these cases, we have 100% visibility to the entire book, and then that will sort of play out, as the renewals actually happen. So retail is definitely a focus area, and there we will continue to track to market or improve on the retail side. Interestingly, on the government side, there's a lot of good work that's happening, especially with Government India's new focus on adding senior citizen care, how states and the central government schemes are coming together to mix and match the benefits, and also the latest announcement on the gig workers sort of eventually getting added to the Pradhan Mantri Jan Arogya Yojana. We continue to stay very focused on the government business, and we've improved even on the government business in terms of the overall top lines. We've grown about 20% on government.
Absolutely. So that is a very good growth that you're seeing there in terms of the share also of the government business. That has also been going up for the company. What I want to understand that, what is the ideal share that you would want between government and retail, and what does that do to your margins?
There's no real specific target. I think the industry has evolved around 3 dimensions, right? Group, retail, and government. We want to track or better the growth rates of respective segments, and whatever be the mix, we know how to manage that as a common back office using technology. So there is no real mix that we are looking forward to, but we want to make sure that in each segment we are better than the market.
Just 2 months back, there were articles that you're eyeing acquisitions, you want to expand your footprint. So where are we in terms of an acquisition? Are you likely to close one in this calendar year, perhaps in the first half of the year?
So we have announced the acquisition of Paramount TPA, the second largest in the group segment after Medi Assist. We have filed for a regulatory approval, Reema, because both of us are
That's known. Is there anything else?
No, I think we will always remain opportunistic. On any opportunity that comes our way, and that makes sense.
Okay, thank you so much for joining in with us this morning on CNBC-TV18 and giving us an understanding in terms of what to watch out for, Satish, from the company going forward as well, in terms of acquisitions also. But yes, that was the management of Medi Assist stock holding on to gains of 0.8% right now. Time for a short break. Don't go anywhere. After the break, the new RBI governor has made in monetary policy tomorrow. What is the street expecting? We'll give you the details on that.